Welcome to this edition of Fuel for Thought. I'm Mike Wall, Executive Director of Automotive Analysis at S&P Global Mobility. In today's episode, we will be discussing the current challenges facing the battery industry amidst a slowdown in enthusiasm for battery electric vehicles. We'll explore the issues of oversupply, underutilization of capacity, and lower return on investments. Joining me today are two experts and my colleagues at S&P Global Mobility, Adim, Manager of Technical Research, and Gabrielle Aversa, Senior Technical Research Analyst. Ali, Gabrielle, welcome. Let's dive right in. Ali, can you provide maybe a bit of an overview on the current status of the electric vehicle market globally, both currently and maybe how it compares to historical performance?
Yeah, sure. So the battery electric vehicles have experienced an astronomical growth during the past year. Basically, from 2015 to 2023, in a span of only 8 years, the production of battery electric vehicles increased from 200,000 to 10 million vehicles, which means the compound annual growth rate as much as 56%. However, starting from the beginning of this year, this rosy picture has turned into a rather bleak one. In the first half of 2024, the year-on-year growth rate has been barely positive in Europe and North America. As a result, we have downgraded our battery electric forecast for 2024 from previously 14.6 million to 12.4 million at the global scale. However, different regions have been downgraded with a different degree. Europe is at the top of the list by about 1 million unit reduction with respect to our forecast last year. This would still make a positive growth for Europe, but at a much lower rate than what it was expected last year. Several key factors contribute to this slowdown. Affordability is arguably the most important challenge that the overall EV industry faces. However, there are big regional differences. In China, the battery electric vehicles have almost reached to a price parity with internal combustion engine cars. But in North America and Europe, the situation is much different. Based on our estimation, there's still a large gap as big as more than 30% between the average prices of internal combustion engines and the battery electric vehicles. Based on our EV consumer survey, the price and affordability have been consistently at the top of the list of the pain points that act against the adoption of EV. The other 2 points on the list include the lack of charging infrastructure and the long charging time. In my view, as the BEV penetration grows, different consumer groups with different usage behavior and expectations should be satisfied. So we are basically transitioning from tech-savvy clients from higher income levels to customers from lower income and the type of customers that might not be open to change their driving habit, the type of customers that might have the possibility to change their charge at their home or might not do not want to wait 1 hour to charge their vehicle. So we need to satisfy all these types of customers and their expectations as we grow the penetration of EVs. And that's, in my view, the main reason behind this slowdown.
That was a great summary of kind of where we currently stand and how things have evolved on the battery electric front. So Gabrielle, taking that into account and everything that, those cross currents that are currently impacting us, how does this slowdown impact the battery manufacturing industry, capacity, and other factors on the battery front?
The EV slowdown has major implications for the battery industry. During the last several years, all of the noise and excitement around EVs has led to a massive investment along the entire battery supply chain. And that includes material sourcing of those critical minerals that go into cells, all the way up to significant battery manufacturing capacity being set up. The growth in EV uptake was expected to continue this battery demand forward, which would require significant expansion of battery manufacturing capacity. But now, as the demand for EVs has decreased from earlier projections, the industry is left with an oversupply situation and underutilization globally. The poor performance of BEV sales in 2024 already has resulted in a surplus of unused capacities for cell makers. As it often goes in a free market, the surplus has resulted in fierce price competition between the cell makers, which is driving prices down. For example, in the past year in China, the price of LFP cells has gone from over $80 per kilowatt hour to below $50 per kilowatt hour. This leads to low margins for cell makers, which is not sustainable in the short term. And in the long term, this leads to only the players with the most efficient processes and the most robust supply chains finding success, which isn't good for the little guy.
We have faced a common anxiety among tier 1, 2, 3 suppliers, which demand has cascaded to upper levels of the supply chain, which has resulted in itself in lowering prices for those levels of the supply chain in a similar fashion that Gabrielle talked about regarding the battery cell. For instance, the prices of the LSP cathode active material have dropped by more than 50% during the last year. The lithium carbon prices have also declined dramatically during the past year as a direct result of the slowdown. These low prices will particularly put pressure on suppliers with low efficiency, probably at the right side of the cost curve. If the oversupply situation lingers, we can expect that the market will be consolidated in a way that we will have fewer companies with larger scale and probably better efficiency. This oversupply situation has also affected and caused quite interesting side effects. Suppliers are basically trying to sell off their growing inventories at very low prices with generous discounts. They have poured other applications like stationary storage with cheap cells, which has created in itself a sort of boom in those sort of applications. In the ESS application particularly, we see projects with unprecedented capacities are being announced on a daily basis, especially in regions like China.
That's a great point. And as you start talking about sort of those regional nuances, let's drill into that a little bit further. And Ali, let's stick with you at least to start with this. Recently we've heard quite a lot of, I guess, troubling news regarding European battery manufacturing projects. Could you tell us a little bit about these latest developments in the European region?
Sure. From what has been transpired from the industry during the past few months, OEMs and battery suppliers are watering down their ambition. Especially in the last month, there have been a few important announcements regarding the postponement or cancellations of the battery manufacturing project. So I try to make it short-lived here. One of the biggest announcements was around Automotive Sales Company, or ACC, which is a joint venture basically between Stellantis, Total, and Mercedes-Benz, which decided to pause their plan for 2 gigafactories that they were supposed to build in Italy and Germany. Apparently, they are reconsidering their chemistry strategy, especially with regards to the competition with an affordable alternative Chinese LFP cells. But apparently, they want to move in a similar direction. Earlier in May, Chinese cell maker Volt announced that they will cancel their gigafactory, one of their 2 announced gigafactories in Germany, which was supposed to reach to 16 gigawatt hour and start production in 2025. In a similar vein, Volkswagen said that it will hold back from taking a decision on its 4th gigafactory in Europe. Instead, they announced a quite sizable project in Canada, probably to benefit from the incentive of the IRA, or Inflation Reduction Act. Another noticeable announcement was around the cancellation of a $2 billion contract between BMW and Northvolt. Northvolt has been struggling, apparently, to ramp up their production and could not reach the production level that was required by the OEM. And as a result, they lost this contract. So losing such a large contract for such a startup might be quite disastrous. We have to see if this player, which is probably one of the most promising and prominent players in Europe, can survive such a big blow. Overall, most of the cell makers are putting brakes on either construction or expansion projects and are waiting to see if the BEV sales pick up again.
When you think about some of the automakers in Europe facing those challenges, significant challenges beyond even just decrease in demand and oversupply, what are some of the other driving factors in these investment pullbacks?
So, in addition to weaker demand, the fall in the Chinese battery prices has put a strain on European players. significant price gap between the European battery and the batteries from China, especially with the NFP technology, has made it very difficult for the European cell makers to compete, especially as the car manufacturers are striving to introduce affordable electric vehicles. Considering the European OEM, they are under a lot of pressure to introduce cheaper EV, whereas the cells they can find in the region are significantly more expensive than the Chinese counterpart. On the other hand, a lot of new players in Europe are still at their infancy. Players like Northvolt or ACC need to first reach to mass production or C-sample, which should be tested extensively according to notoriously stringent automotive standards, and only then the cells can be used in the battery production. Any new factory, in addition, especially for the startup, face huge scrap rate at the beginning of the production until the processes are optimized. This particularly put additional pressure on the startup that need to compete with the incumbents in terms of reliability and the price. In addition, Europeans are in competition in two fronts, from China and North America. I talked about the Chinese part, which is basically aggressive price positioning, which is hard to compete. But on the Western front, on the other hand, during the past 2 years since the introduction of the Inflation Reduction, we have observed a sort of competition between the two regions in terms of absorbing funds and investment. Many players prioritize North America, at least in the short term, due to lucrative incentives of the Inflation Reduction Act. Even some of the European-originated players like PowerCo or Northvolt announced their plan for the facilities in North America, which was a bit controversial as they were benefiting from the European taxpayer money. And Europeans do not benefit from legislative protection as opposed to Americans. In the US, in addition to generous incentives for local cell makers in terms of production tax credits, the Chinese imports are severely penalized due to both foreign entity of concern, which aimed at exclusion of the Chinese cells from the EV tax credit, in addition to 25% import tariff. In the EU, there's only import tariff as big as 1.3%, which is definitely not enough to curtail the import from China and drive localization. Some players are calling for higher import tariffs in Europe. However, higher tariff would mean that the European EV buyers should pay more for an EV that is already too expensive. This would then jeopardize the achievement of the overarching decarbonization goal, especially the ICE ban in 2035. However, some of the European countries are introducing some restrictions at a national level. For instance, in the eco-bonus, which is the EV subsidy structure in France, the vehicles that use Chinese cells will be excluded from the tax incentive, as they are evaluated to have higher carbon footprint. Something that is not completely fair, because based on our estimation taken from the carbon footprint forecast, we have realized that actually there are a lot of production capacities in China that are leveraging the renewable energies and have reached already a quite interestingly low levels of the carbon footprint. And then in addition, prominent players like BATL have ambitious goals not to only decarbonize the cell production, but also the entire value chain. So the combination of price competition, weak demand, and lack of legislative protection is particularly hurting the European battery industry, at least in the short term.
That's a great, I think, update on kind of where the European industry stands right now. Gabrielle, let's turn to the North American battery industry, which is also facing some, I think, well-documented headwinds right now. How has that market been responding?
North America has also been seeing some delays and divestments as a result of the current EV market and slowdown. For example, recently this year, we saw in the United States that Ford has scaled back its battery investment plans in a new plant in Michigan. While the company is still moving forward with the project, the planned capacity in kilowatt hours and the job creation have both been reduced by about 40%. Also, this year as well, we saw Panasonic, one of the biggest cell manufacturers in the United States, has canceled one of its battery plants planned in Oklahoma.
So, what are the problems in North America that led to these issues for both OEMs and the cell makers?
North America has a few unique problems, especially coming right off of Ali's description of the European issues. So the US is not currently being impacted as much by the price competition with China. This is due to a resistance to the adoption of Chinese vehicles in the United States, as well as to some extent Chinese batteries. But one of the most pressing issues is the lack of lithium iron phosphate or LFP supply chain in North America. LFP batteries are much cheaper compared to other battery chemistries, and they're already very prominent in regions like China. But the supply chain for LFP is highly concentrated in Asia as well. So, the absence of the domestic LFP supply chain in North America makes it very challenging to produce affordable electric vehicles in large volumes. There are some upcoming projects to manufacture LFP in North America. For example, we have Tesla, which has big plans to produce a lot of LFP cells in Nevada in the next few years, and Goshen is setting up an LFP cathode active material operation over in Illinois. But these plants are going to take time to ramp up, and so the projects are still a few years down the line from manufacturing a significant amount of material. So a lack of LFP cells in the near future hampers the growth of the EV market, as affordable options are crucial to increasing adoption rates. Another challenge is the imposition of the higher import tariffs we've seen announced this year on both lithium ion cells and even more so critical minerals. The tariffs add to the cost of battery production for North American cell manufacturers, and this increases prices and ultimately decreases competitiveness. However, overall, North America has largely seen less cancellations and pullback than Europe due to the recent government incentives in the United States.
Yeah, speaking of those incentives, what do the U.S. government incentives currently look like?
So, as Ali referenced earlier, the Inflation Reduction Act has had a very big impact on the North American EV outlook. So, the Inflation Reduction Act, or the IRA, was passed by a bipartisan effort in Congress back in 2022. It has several incentives for the growth of the EV market, and more specifically, incentivizing the domestication of the battery supply chain in North America. Among other things, the IRA includes a production credit of up to $45 per kilowatt hour for battery components manufactured in the United States. It also has a consumer tax credit of up to $7,500 for eligible EVs. Now, in order to be eligible, the vehicles must have batteries and battery critical minerals with a certain percentage of their value sourced from either North America or a country that the United States has a free trade agreement with. This percentage of value ramps up over the next few years to allow some time for the infrastructure to be set up locally. The other big factor of these eligibility rules is that they exclude batteries with any portion of the components or minerals coming from countries that the U.S. has determined as foreign entities of concern, or FEOCs. Right now, these have been identified as China, Russia, North Korea, and Iran. The FEOC rules are a key point to try to incentivize the battery supply chain to move out of China, where it's highly focused right now, and eventually come to North America. In 2024, this consumer tax credit became eligible to be implemented at the point of sale. And this is huge because it's essentially providing a $7,500 discount to any eligible EV right when you buy it. Prior to the IRA, the battery supply chain in North America has been fairly limited, especially upstream, looking at critical minerals like lithium and graphite that are largely found in places like China. Since the passing of the IRA, many OEMs and cell manufacturers have announced new projects in North America, both for cell manufacturing and upstream in the critical mineral space. Since 2022, expected North American cell production capacity has increased significantly through the end of the decade. We're now expecting an increase of 30%.
That's really helpful. As of the recording of this podcast in the U.S., we are in the throes of a presidential election. I'd be remiss if I did not ask you, Gabrielle, are there any risks to the government incentives with the upcoming presidential election?
Yeah, and of course, with any election with most government policy, there are going to be risks. Now, on the one hand, the IRA passed through Congress with support from both parties, so it seems unlikely that the entire bill will be scrapped. Also, the production incentive, that $45 per kilowatt hour, is largely benefiting red states, as many of the battery plants are in places like Oklahoma, Tennessee, and Kentucky. These are very large projects employing thousands of people, so the production credit is likely to stick around no matter the outcome of the election. However, if former President Trump is reelected in November, there is a chance that the consumer tax credit, so that $7,500 that's given at the point of sale, could be scrapped or greatly reduced, and that could heavily impact electric vehicle demand as it drives the price up that the consumers are having to pay.
So a lot of things to consider as we go headlong into November here, and with some big considerations for the U.S. government, U.S. market, at least on that front. Final question as we start kind of wrapping up our conversation. I'd love to get some feedback from both of you in terms of sort of what's the general outlook for the battery industry, both Europe and North America. Maybe Ali, let's start with you. Just trying to help us wrap our minds around where we see the market, especially the battery industry going forward.
In our base forecast, we believe that this slowdown will be only short-lived. In the short term, car makers can probably switch to mild hybrid or plug-in hybrid to meet with the emission target. But in the longer run, meeting with the more aggressive emission targets is only achievable if you have a sizable EV in your fleet and production. So that's why we believe that, this downgrade affects only the short time horizon, and the picture for the e-mobility revolution and the transition to the electric vehicle will not be affected that much. But as Gabrielle also said, this scenario is hugely under the assumption of the legislation, and probably the legislation are the biggest risk factor in our forecast. Speaking of Europe, if Europeans decide to postpone the internal combustion engine ban in 2035, that would have an enormous impact on the BEV outlook in the region. However, rolling back from such legislation would have huge ramifications. Tens, if not hundreds of billions of dollars have been already invested by OEMs, cell makers, and the entire EV value chain, and changing the targets would be quite disastrous. Probably we should not forget the bigger picture here. So the main reason for such legislation was the decarbonization of the mobility sector, which was necessary to combat the global warming. So in my view, the solution should be found within the existing framework and not outside of it. There are a lot of lessons, for instance, that can be learned from China. They have been very successful, not only in establishing a flourishing battery supply chain, but also achieving price parity goal, which has been the holy grail of the EV industry since its inception. We can see that EVs are growing organically with minimal incentives in China, which should be regarded as a proof of concept for the e-mobility in general, and should be copied by Europeans and Americans, in my opinion.
Gabrielle, how about North America?
The outlook for North America is largely similar to what's being seen in Europe in that it really comes down to legislation. I think the success of current incentives can be seen in the relatively smaller amount of cancellations and delays we're seeing in North America compared to Europe, which both regions are facing similar slowdowns in the EV space. Some of the headwinds that the North American market is facing, like the limited LFP supply chain locally, can greatly benefit from the IRA incentivizing local production. However, the governmental push away from a dependence on China, it also includes high import tariffs, which may lead to more issues for North American suppliers. But overall, I think a continued emphasis on domestication of the battery supply chain in North America is likely to sustain local production products despite the slowdown in this short term. And as Ali said, we do expect to see growth long-term in the EV space.
Well, this has been a very interesting discussion, to say the least. I know I've learned a lot. Thank you both, Ali and Gabrielle, for sharing your insights. As the industry navigates these complexities, it's going to be crucial to find a balance between investment, growth, and profitability. Thank you also, everyone, for listening. Please share this podcast link with colleagues and in your social media accounts wherever you can. Don't forget to follow us on LinkedIn at S&P Global Mobility and explore our products and offerings at spglobal.com/mobility. We'll be back for more Fuel for Thought next month. Have a great day.